In order to evaluate a SaaS company, what do you believe is the best indicator to apply a multiple? Revenue, ARR, EBITDA, net income, other multiples. How do you think about this?
So, hey, the classic and the standard in the industry for early stage is going to be an ARR multiple for good or bad. So this is what is mostly that valuation. But I think for early stage, I think later stages and pre-IPO, IPO companies, that gets way more technical. But for earlier stages, like it's going to be a proxy, right? So you have a multiple on ARR and you have a range. And that can be from, I don't know, let's assume 10 to 20, right? So something along those lines, potentially. But then they will look at your efficiency metrics. And then they will say, well, what's your NDR? What's your CAC payback? Well, it's not technically efficiency metrics, but some other metrics, right? Some other metrics that point at the quality of your business. NDR, CAC payback, burn multiple, like there are some others. And then judging with this, they will apply, okay, you are more on the 10 side of the range or you are more on the 20 side of the range. And to be honest, venture capital is not much more sophisticated than this and the early stages. And, how you assign a multiple to the quality of the funding team. Like, I don't know, you try to rate them and, they look great, awesome. So let's pay more. So, this is the case for earlier stages again, right? So obviously once a company has more years of track record and growth and financials, then you get more closer to growth equity valuation or even private equity valuation, of course, and it becomes more again sophisticated. And then the classic, you will start going down into either EBITDA or EBIT multiples, which are more standard in the industry as you move to later stages.
Yeah. When do you think that flip happens? Is it at a certain, ARR or size of the company, or maybe even, distribution of the customer base? Like, when does that happen usually?
I would say around Series C or D. I think that tends to change then. But I've also noticed that it will depend as well, regardless of the stage, to the investor you talk to. So you might be in earlier stages, but if you are not growing very fast, but your efficiency is very good, like you may be talking to small cap private equities, right? And then the conversation is very cash flow driven, and that's it. Whilst some other businesses, maybe even at later stages, still, they are growing very fast, their efficiency is very questionable, but then they get crazy ARR multiples, and yet they find themselves in this race to grow into that valuation.
That makes a lot of sense. I think from what we've observed, it tends to happen somewhere around that 5 to 10 million ARR revenue stage when you cross overlay between venture and growth and PE investors. And to your point, a lot of it depends on not only revenue growth, but your gross margin, your EBITDA margin, and then ultimately the quality of your customer base, right? And your efficiencies around how you're distributing your product to your customer base. So, I've heard things like rule of 40, rule of 50, which means if your growth and net adjusted for your burn is below that, then you're probably going to be talking to that growth PE investor, right? And if it's above that, then you'll probably talk to more VC investors, but it sits on a spectrum of somewhere along those lines.